Yes, sir. Here we go. Yo, what's going on, guys? Welcome to another video. In today's video, we are going to talk about the stock market. So let's go ahead and get right into it. First things first, I didn't realize this until I actually looked back. If we look at last week, the S&P 500 fell 4.64%. And then if you look at the week before that, the S&P 500 fell 4.77%. That's almost a 9% drop in the S&P 500 within the last 2 weeks. So essentially the S&P 500 has essentially fallen in a straight line. Like it's just gone straight down, which is actually pretty crazy. But that tells me right there, you guys know how the stock market works. I don't have to tell you this. You guys know how it goes. The stock market generally doesn't fall in a straight line. So even though I think we're going lower, we probably are bound for some sort of short-term rally. That's just kind of how it goes. You guys know how that whole thing goes. Another stat I want to present to you guys is last week, Google, Microsoft, Meta, Nvidia all made new 52-week lows. For me personally, I still think Microsoft's overvalued a little bit, so I'm just not interested in that stock. Obviously, I love the company. I'm just not interested in buying here. You guys know I absolutely hate Meta. So Meta's a no for me. And then for me, Nvidia is still a little bit overvalued. So I wouldn't personally pull the trigger on there. And Nvidia's got a lot of pain coming to them for everything that's going on with that company. So I'm just staying away. The only company that I actually bought last week, guys, was Google. Google was the only company that I bought last week. So I was very comfortable buying that. That doesn't mean that you can't buy some of the other stuff, because don't get me wrong, Meta, which is Facebook, is extremely undervalued. Like there's no doubt about it. But I personally think that Meta's a value trap. I'm not a fan of it. I'm not bullish on it. I'm personally staying away. But if you like the company, Meta's also a good buy too. Do not get me wrong. Now, here's something that I really wanted to point out to you guys. If we actually go ahead and we take a look at this chart right here, I actually drew a line for you guys so you can see exactly what I'm talking about. It looks right here. It kind of looks like the S&P 500 is only 6% away from the entire COVID gains being wiped out. So now we're not just talking about 2021. We are now talking about the 2020 gains that we're seeing. So essentially this means that if the S&P 500 goes to 3,300, which I very well believe that it will, as a matter of fact, 3,388 is what I got drawn here on this chart. If the S&P 500 goes to 3,388, which I think it will, we will have wiped out all of 2020 and 2021's gains. I know that sounds crazy. It's like, how can this happen? Well, it's important to understand. We talked about this before on this channel. 2020 and 2021, those gains were directly caused by the Fed. The Fed is now taking the punch bowl away. They're raising rates. They're being hawkish. They're being aggressive. They're doing quantitative tightening. They're doing everything they can to one, bring down inflation for sure. It just wouldn't surprise me to see us go down even further than those 2020 to the point where we're wiping out those 2020 gains. It just wouldn't surprise me. Now, let me go ahead and show you guys something else. The Goldman Sachs price target. So I didn't realize this till I actually went on Goldman Sachs website and found this. Goldman Sachs actually has an entire chart here, and I actually really like this chart. So let me go ahead and show this chart on the screen. So Goldman Sachs reduced their price target for the end of the year by about 16%. So their new price target for the S&P 500 is 3,600. You can see right here on this chart. You see right here, this is their soft landing scenario, and then they have their hard landing scenario. So in the situation of a soft landing, they think that even with the soft landing, the S&P 500 is still going to end this year at 3,600, which would not surprise me at all. They're probably going to be right. Would not surprise me at all. If there's a hard landing, then they think that the end of the year, their S&P 500 target is 3,400. That's what the Goldman Sachs has. Now, 2023 is actually very interesting because I talked about this on numerous occasions, whether it was on my live streams or my actual videos. I've said that I actually think that 2023 is actually going to be bad as well. And I haven't exactly brought this to you all's attention yet, but I'm going to go ahead and say it now. Based on the research and the looking that I've been doing, I would not be surprised if the market traded sideways for a few years. And yeah, it just wouldn't surprise me. It could just stay in a range and just trade within that range for the next few years. And that's kind of what Goldman Sachs is kind of painting right here. So if we look at right here, 2023, in the event of a soft landing, they still have the S&P at a price target of 4,000, which again, you know, we've said on this channel many a times, I don't know why anybody will be buying stocks when the S&P is at 4,300. I said that numerous times. You know, you don't want to buy at the top of these bear market rallies because Typically, after bear market rallies, we reach new lows. That just is what it is. Now, the S&P 500 has their 2023 year-end price target of 37.50 if we indeed go into a hard landing. I love that the Goldman Sachs is doing this, because before they slashed their price projections, guys, literally for this entire year, everybody on Wall Street had these insane price projections for the S&P 500. If I could find that chart, I'll show you. But there's this chart of all these like big time Wall Street analysts giving all these crazy price targets, like Tom Lee. You know, the S&P is going to end the year at 4,700. Then you got a bunch of other analysts saying, oh, the S&P is going to end the year at 4,500, 4,400, 4,300. Goldman Sachs is actually freaking being reasonable. Goldman Sachs is coming out here and saying, no, we're probably going to end the year at 3,600, which I agree. That's exactly what's very likely going to happen. And I'm just here to point that out to you guys. Now, if we actually go ahead and look at the Fed speakers, this upcoming week is actually going to be very interesting, especially Monday. And the reason for this is because you literally have like 50 people from the Fed speaking. Like every single person from the Fed that can speak is speaking this week. Like it's crazy. I'm going to go ahead and show you guys right now. So we look right here at this Fed calendar. You can see right here on September 26th, which is tomorrow. That's Monday. That's actually my girlfriend's birthday. So happy birthday to my girlfriend, which her birthday is tomorrow. I'll give her a shout out. September 26th. You have the Boston Fed President, Susan Collins, who speaks, Cleveland Fed President, Loretta Mester, Atlanta Fed President, Raphael Bostic. They all speak tomorrow. Then September 27th, you have Chair Powell, who speaks. Then San Francisco Fed, Mary Daly. Then Chicago Fed President, Charles Evans. Then you got Bostic. Then you got Evans again on September 28th. Then on the 29th, you have Mester, Daly. Then on September 30th, you have Vice Chair Brainard. Then you have New York Fed President Williams. So the bottom line is, guys, we're going to have a lot of Fed speakers speaking. We know the Fed is extremely hawkish. That's why the market is finally reacting the way that it has, because the Fed has already been hawkish, I would argue. But now the Fed is really, really letting the market know that, you know, no, we're going to continue to be hawkish. The Fed's funds rate is going to be higher than you expected and all that different stuff. So that's just kind of where we're at with it. So overall, what am I trying to explain in this video? Well, it is mostly the fact that the trend is bearish. Wall Street is finally starting to catch up. At least the major banks are. I think that you're going to eventually start to see more of these people start to slash their year-end price targets for the S&P 500. But again, we're going to have bear market rallies. We're going to have short-term, you know, rallies and different things like that, even in individual stocks, maybe even in the clown stocks. But overall, I think that the trend is bearish. This is why I am a fan of Michael Burry. Michael Burry has been warning this all year. And if you actually do your research on Michael Burry, you will learn that Michael Burry is not a perma bear. Now, somebody like a Peter Schiff or Robert Kiyosaki, yes, they are bears every year. But Michael Burry actually isn't like that. He's not. He's just really good at predicting and figuring out this stuff. And in my personal opinion, I strongly believe that Michael Burry is right. So far, it's looking that way. I think Michael Burry has recognized that the current economic environment we're in has caused the trend to be extremely bearish. So like I said, guys, the way that I'm at with it, this is where I am with it. I'm not as smart as Michael Burry. I can't time this stuff like he probably will be able to. So for me personally, now that the S&P is in a bear market, I think the Dow just reached a bear market. The Nasdaq's been in a bear market all year. I'm fine with buying here. I am fine with buying a little bit here. Again, we're putting some cash to work. I do still think you want to have cash in this type of environment. As a matter of fact, you always want to have some cash on the side in this type of environment. And I do still think that we are going lower. So anyway, there you guys have it. That'll go ahead and conclude today's video. Thank you guys so much for watching. Feel free to like, share, and subscribe. And I'll see you guys in the next one.